I was sitting there going, I got to ask Zach today. So tariffs on, tariffs off, tariffs back on, market up, market down, market sideways, market confused. Well, I don't even know what's going on. You know this better than anybody. Markets likes consistency, and this is a hard place to find any consistency.
Yeah, it is. And one of the things, without getting too far into it and getting askew, it really amazes me the overreach of the judicial branch, because regardless of what you think about the tariffs and what Trump has done, you and I have talked about, I thought the rollout of these tariffs could have been done much differently. And not at all sitting there saying that, I think the execution's been flawless. At the same time, once again, the judicial branch of this government is just out of control, meaning they're sticking their heads and their faces into things that they just don't belong in, meaning you saw that court come out and try to stay the tariffs. The president has tariff power. He has for a very long time. It is well established. Whether you like it or not, there's nothing that court can do about it. So, tariffs came off, but halfway through the day, you saw tariffs come back on, right? And so there's got to be tariffs. As much as everybody doesn't like that. And you know what? I am not saying, like I've said from the very beginning, we got to wait to see where we end up, right? We're not going to know whether Trump succeeded or didn't until we see a final trade deal with China and see the way this all, sorts itself out. That being said, elections have consequences, and you may not like what Trump's doing, but we've got so many different factions of this government that are just constitutionally out of control. These judges just think they can, district judges that think they can stop, deportation of people they've got no jurisdiction over. And then now this group jumping in and sitting there saying, you can't do terror. Yes, he can. It's well within the rules. And if you don't like the way he classified them this way, he can run them through this other piece of legislation that gives him tariff power. And so, again, I'm not saying I think the tariffs are all great. I'm not saying I think they're all bad. I'm just stating a fact. And we've got to get among all the other issues that we're dealing with, we've got to get judicial restraint put back in. And to go to the point that I was going to make was, nobody wants the tariffs because nobody wants to take economic pain. Again, we got to wait to see if the tariffs work, to see the trade deals. But nobody wanting to take any pain is precisely why we've got a massive debt and deficit problem, right? Like, people in this country need to grow up, man. You can't have your cake and eat it too. And a lot of times doing the right thing is the thing that feels the worst, right? And it's really looking at the budget situation, looking at the tariff situation, looking at social spending. It's a madhouse. And then you see this budget come out, the resolution that the big beautiful bill. Last year we spent $6.4 trillion. The big beautiful bill is going to push us over $7 trillion.
So, yeah, and that's crazy. That right there, I was sitting there looking at this thing thinking, this is not what, okay, the tariffs, I understand that, but you're asking now to balloon even more for a couple, debt ceilings to 2 trillion, then another 2.5 trillion. And you're not asking for those if you don't think you're going to spend it. So how does that play into the investment world when you see stuff where it starts to balloon like that? The bond market, I think a lot of people look at the bond market. Okay, why does the bond market matter in this situation?
Okay, so first of all, every asset, you stick your head out your window, okay? Every asset you see at the bottom of that is debt, underlying debt. We talk about banks' capitalization, right? If bonds, remember what happened in 2023, right? Silicon Valley Bank failing? That was, or was that 22? I think that was 22.
Yeah, 22.
Okay. What do you think banks have on all their balance sheets? All their capital is the vast majority of it is stored in U.S. Treasuries, right? So those U.S. Treasuries start getting hit. The bank's got a problem, all right? The other side of it is this. You're the world reserve currency. The most widely owned asset in the world, or assets in the world, are U.S. bonds and U.S. dollars. if you have foreign holders starting to see that there is going to be higher rates in the US, which means losses on long duration bonds, right? And on top of it, okay, so let me reverse for a second. What got us here, right? So you've got this place now where the United States, the S&P 500 is trading right around 30 times earnings. If you factor in stock compensation, which I think it's an absolute crime that stock compensation isn't accounted for like regular payroll, but it's a little loophole, and virtually all these big tech companies are doing it, and other companies are doing it too. But anyway, it inflates your earnings. It makes your earnings look artificially higher than they are. And makes your stock makes it look like there's an artificially low amount of shares outstanding. Bottom line, it pushes your PE ratio down and makes your stock look more affordable, right? So you pull that out. Realistically, you're probably trading at between 35 and 40 times earnings. So you're right up there, getting close to .com bubble type highs, right, on the S&P 500. And if all of that, and you and I have talked about this, the other crazy stat, the United States economy makes up 20% of the global economy, 20 to 25, depending on who you're listening to and how they tabulate it. But our stock market makes up 70% of global stock market valuations. Okay, that is nowhere close to normal, right? Typically, we'd be around like 40, 45. Okay, so you're almost double that amount. And no country in the world, no singular market in the world has ever gotten close to that. I think I told you before, Japan was an extraordinarily crowded, overpriced market in the 80s. The peak it got up to was 39% of global market cap. Okay, we're almost double that. Okay, so the reason you got there is because coming out of the financial crisis, there was only one country in the world. China did a lot of stimulus too, but they have a closed capital account, so you got to look at them differently. But there's really only one country in the world that could stimulate its way out of that issue because they didn't have to worry about their currency value, right? That was the United States. Meanwhile, think back to the European debt crisis. Remember Mario Draghi back in 2011? Whatever it takes, right? What was happening? The euro was getting pounded. Nobody wanted to own euro bonds. So over the last 15 years, the way the U.S. market has gotten so overinflated is because, again, it was the only one that could print. Whenever you hear about a government or a central bank printing or issuing fiscal stimulus, that is the equivalent of a restaurant ringing a bell and saying free food. Okay, all the kids in the neighborhood are going to flock there, right? All the capital is going to flow to that economy. Well, that has gone on for 15 years. So every other market in the world has become like a roach motel. There's nobody there. And whoever's there, they don't have the exit liquidity to get out, right? These markets have been just starved to capital. Everybody in the country is dumped in there, everybody in the world is dumped in there. If you're an asset manager running an equity fund anywhere in the world and you haven't been primarily in U.S. assets, you're probably not a money manager anymore, right? You probably had all your clients pull their money. So you had every impetus, everything was driving money in. And one of the biggest things that was driving money in, Chad, was the fact that a lot of these international investors weren't worried about valuations because they were more concerned about their own currency value, right? Meaning, let's say I'm in Taiwan, okay? And I throw a chunk of dough into the U.S. markets and the S&P drops 20%. But the Taiwanese currency, and I can't remember what it's called. Oh, I'm blanking. It's not the bot. I'm forgetting what the name of the Taiwanese currency is. But let's say the Taiwanese currency depreciates 30% against the dollar, which that's not an abnormal move in a period of crisis or when markets drop 20%. Well, if your U.S.-based stocks drop 20%, but your local currency devalues 30% against the dollar, you're effectively up 10%. Right. So even when their U.S. assets got hit, typically the dollar soared in value, and on a local currency basis, they were coming out ahead anyway. Okay, what's happening now? It's the exact inverse. Now you have the impetus and you have the need because of heightened trade wars, global geopolitical tensions. It's not just all the tariffs. This was going to happen anyway, which is why we were getting into international equities going into this year. But now you have reasons for money to start leaving. What have you also seen lately? The dollar index broke the $100 level, right? So it's down to 99 and change now. So all of those factors that were driving all of this capital into the US for 15 years. I don't want to say that they've reversed, but the wind is no longer in the sail of that ship, period. And so what we think you're going to continue to see is, I think you're going to continue to see US markets struggle, and it could be for an extended period of time, because every time you see a rip, you see people selling into that rip and moving more money offshore. And they're going to keep doing it. They have to. We think the uptrend in the dollar is over. So when was the last time international investors were worried about currency issues in the United States? When was the last time anybody around the world was worried about their dollar denominated assets? It hasn't been in my lifetime.
No.
Right? So these people, what people need to understand is international investors have to start moving money out. They have to, right? Foreign central banks have to diversify their dollar exposure. They have to. So all of these inroads we're pumping money in. Now, virtually all of them, again, and it's not a crisis. It's not anything to be panicked about. It's still being orderly. I don't think the market's going to collapse or anything like that. I just think that you're really up against it. And I think American investors don't really understand what's been driving equity prices for the last 15 years. And they're certainly not aware that those factors, by and large, are gone.
Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. I want to talk about one company, Apple. There's a book out. There's a bunch of stuff out. I'm sure you've seen it. Apple's getting its ass handed to it by the Chinese. Mm-hmm. And Cook has some serious issues because it's not just the tariffs or the threat of that or removing stuff. The fact is that they're losing market share and in a huge place like China, but they're also losing it here. The luster seems to be off Apple, and that is a scary thing because so many people have Apple.
Oh, and they're not paying attention to it, and they also don't realize that Apple right now, okay, their growth is gone. They are losing market share. The growth that Cook promised was coming from the services sector. Even services missed in the last quarter. Okay, not only has the shine come off Apple, but it's trading at double the valuation that it averaged all the way up, right? When it was growing 20% a year, 25% a year, the stock was trading at 18 times earnings. You're now at 33 and the growth is dead, right? Here's another one that's going to blow people's minds. I don't even think people are aware of this. Do Google in last year produced more revenue than Apple, double the profit margins, and more profit, right? That blows people's minds. Everybody's like, oh, Google's a smaller company. Apple's the king. No, they're not. No, they're not. Here's another one that'll blow your mind. Do you know that over the last 2 years, Apple has lost market share to, drum roll, Google Pixel? The Pixel phone has stolen market share for the last 2 years, and their sales are going up. Nothing crazy, again, not crazy, but when have you heard that anywhere? Is anyone talking about that? And why is that such a big deal? Apple is one product. It's it. That's their one product, okay? And here's the thing. Most of us own iPhones, so we don't really know. Go try a Google Pixel or even a Samsung. They smoke Apple. It's not even close. There's been no innovation in these phones. Cook hasn't innovated anything. The best thing he's brought is the AirPod. That's it. Headphones, right? Yeah. I don't think Cook is a bad guy. But what I think you've seen with Apple, it's what Warren Buffett used to refer to when they let the CPAs take over the company, right? And it all becomes optimization. If you look at Apple's innovation, they have become exactly what Steve Jobs hates. None of their innovation is aimed at making better products. It's aimed at trapping you on the platform, right? That's what iMessage is all about.
Huge battle with them, right? Because you've seen big gaming companies, you've seen all kinds of say, we're done with you guys.
Yep.
You want to they're open source over here. Everybody's having a good time. You guys are like, buy our product, stay in our product, don't leave our product.
Yeah, and it never works. You don't coerce consumers. It's never been a good strategy over the long run. Eventually, another option comes out. And when you look at the way, I just heard this the other day too, and I don't know if it's still there, but I think I want to say Google, one of the platforms rolled out a software update that can actually let you text message with iPhones and come up as a blue message, right? So they're going to find hacks around this stuff. They're going to penetrate it, but more and more, I think you're just seeing people starting to wake up. I mean, it's like their virtual reality headset that came up, right? So Meta puts out the Oculus for $600, and it was phenomenal bang for the buck. Okay, Apple launches their VR headset for $2,500, and it was trash.
Made people sick.
Trash. What?
Made people sick.
Yeah, it's just trash. And like that never would have. Steve Jobs never would have let it, let it onto a shelf. It was garbage. So, and you're right, man. And here's the thing: whenever I have conversations about this, we have people come in all the time with big piles of Apple stock. And usually the excuses are, well, I don't want to sell it. It's gone up so much. And I'm like, well, I mean, that's kind of the point, right? You got to cash it in at some point. The other part of it is, I don't want to pay the cap gains. So in those situations, what we've been doing is we figured out, we were just dealing with a client the other day, and he had about $6 million in one of the big tech companies. He was an employee there. And we figured out how to cash out $2 million of his stock without any capital gains. And then we used option straddles to protect the rest of it, and then set a divestment schedule over the next 3 to 4 years to right size that position. So we've insulated from the capital gains, right? And we've also insulated the position against significant loss. And I think that's what investors need to start doing, and they need to right size their portfolios, right? What drove your having 40% in Apple for the last 10 years was awesome. Okay. But you guys got to remember, this isn't me trying to fortune tell, right? Apple is trading at 33 times earnings unless they return to double-digit revenue growth, which they're still declining at 5%. There's no way they can support that price over the long run. There's just no way. It's just way too expensive. Then you start comping them. Remember I told you Google, higher profit, double the margins, higher revenue, way more revenue streams. They're launching Waymo, YouTube, Google Pixel's coming on. Google has a chip business. They're making chips that are kicking butt. They're big players in the AI space. Go look at Google, right? All that Google's growing at 13.5%, Apple at 5%. Google's trading at 18 times earnings, Apple's at 33. It makes no sense. And I'm not telling you to go buy Google. What I'm telling you is, guys, you got to pare back your Apple exposure. If you don't know how to do that without racking up a bunch of cap gains, or if you need to do it over time, contact somebody like us. We can help you out. But you don't need to sell it all, but no portfolio should be 25 to 40% in a single stock. It's just a horrible idea. So
no. Talking to Zach Abraham, Chief Investment Officer, Bold Capital. Last question. How does Elon repair all of this? I think when he got into this, it was exciting, but he's frustrated. He realized, oh my God, bureaucracy and the evil that is the courts, the way that the unions have positioned things, the way they've been voted in, the lobbyist, and it's huge. And all the while, my companies have taken a beating. My name has taken a beating, and I got to build this thing back up. How does he do it?
On the personal side, I think a lot more of that is overhyped. In terms of, 90% of the mainstream media wanted him to fail, right? So, I think a lot of it is an echo chamber. On the business side, Tesla's in a tough spot. They just are. Because Tesla, everybody is pretending like this has to do with Elon's involvement in Doge. Go back and look at January and February numbers. Go back and look at fourth quarter numbers from last year. Tesla's sales in Europe were down 50%. 50. Okay. What is happening to Tesla is about one other company. It's BYD, the Chinese EV maker. That's what this is all about. So I don't know. For Tesla to be able to maintain, let alone go up here, you want to talk about an expensive stock, man? $1.2 trillion market cap, and their revenue is getting smoked. And those numbers are going to continue to look worse because BYD just cut their prices by 30%. Just recently, on top, they were already half Tesla's cost, right? So you go buy a BYD car, You can get a 300-mile charge in 5 minutes. You've got substantially better looking interiors. You can get all that for like 50% of what a Model 3 costs. So they're eating Tesla's lunch. So for Tesla not to be in a really bad spot, and I'm talking like taking an 80% drop from here, they've got to get robo-taxis out there, and they got to get them out fast. Only problem is they're still behind on full self-driving technology. So Waymo is just sucking that market up. Another company that's owned by Google.
Yep.
Waymo right now owns 100% of robo-taxis, right? And then here's kind of the difference in the tech. This will tell you one of the problems that Tesla's up against. Tesla has to have drivers on standby that are prepared to take over the robo taxis manually themselves. Waymo's technology is to a point where they don't need that, right? So that kind of tells you the technological gap between the two. So bottom line, man, he's got to figure out how to take a big chunk of market share away from Waymo and the other. BYD is going to launch. BYD is going to launch robo taxis too. Like, think about it. Their robo taxis, the cars cost half as much. So it's going to be way easier for them to scale that business, right? Waymo partners with other car manufacturers, so they don't take 100% of that hit, right? He needs to launch robots, and he needs to get robo taxis going, or Tesla's in big trouble.
Talking Zach Abraham, Chief Investment Officer, Bulwark Capital. If people want to reach out to you, they want to get a second opinion, what do they do?
I go to bulwarkcapitalmanagement.com or listen to our daily show. Try to keep it between 30 to 45 minutes at the longest. Daily Dots, we discuss everything politically and financially that happens in markets or that affects the economy. So goal was to have a 30-minute show. If you just listen to that, you'll know every important thing that happened in the day as it relates to, finance and investment. So you can get that Know Your Risk podcast. We're on YouTube. We're on all the social media sites. You can Google Know Your Risk podcast. Not too tough to find. Yeah, if you just know Your Risk podcast, Bulwark Capital, not tough to find.
Good to talk to you, brother. You have a good one. We'll do it next week.
All right, sounds good. Thanks for having me.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.